Hello and welcome to an introduction to cash flow forecasting for small charities. We are Embrace Finance. We are a small non-profit supporting other small non-profits to build financial confidence because in our experience, it's financial confidence that unlocks longer term financial resilience. And we provide training, mentoring and resources, and we specialize in small charities with an annual income up to 500k. Cash flow forecasting is an essential step in the finance cycle. It's looking forward. It's where so much of our resilience sits. We, in this really brief recording, are going to look at what the template looks like, what the red flags are, understanding the going concern concept, and what to do when you've got question marks over that. This is not a professional advice session. Um, what is cash flow forecasting? Let's go back to first principles. It's a prediction. It's a guesstimate of the future, what the future is going to look like in terms of income and expenditure, so that we can predict our closing bank balances over a specified period of time, which is usually 12 to 15 months. We do it for really valid reasons. If you haven't got any finance reporting in your organization at all, have a cash flow forecast. We do it to stay in control. A cash flow forecast predicts when our charity might run low on cash, and it can really help us avoid last minute financial crises. We do it to fulfill legal and regulatory duties. It helps us avoid trading while insolvent, and we want to avoid that. That can carry, that has consequences. And we do it to build confidence with ourselves and with stakeholders. It's really a clear mirror, actually, on our financial position, and it helps demonstrate sound financial management to all those people that might be interested, trustees, funders, and regulators. And it helps us take financially informed, not necessarily financially led, although sometimes when the numbers go the wrong way, we might need to be financially led, but it certainly helps us take informed decisions because it highlights periods when additional funding or cost cutting might be needed. It tells us one possible version of the future where we might actually run into trouble, and it buys time for us to fix it. And so I just want to go down the rabbit hole and have a note on two legal concepts that I've already mentioned. Going concern, which is an accounting principle. It assumes a charity will continue operating for the foreseeable future, which is unspecified, but usually 12 months. And trustees are required to assess their going concern status when they prepare their year-end accounts. And we make a positive assertion as trustees in our year-end accounts that we have made this assessment and we are confident we are a going concern. A cash flow forecast is what gives us the evidence, the assurance that actually there is a possible, very realistic version of the future where we are a going concern and can make that assertion with confidence. Insolvency is a legal status, and it's when a charity is unable to pay its debts as they fall due, which is known as cash flow insolvency, but could also be because liabilities exceed assets. So what we owe out is greater than what we own, and that's a balance sheet insolvency. And you can actually be able to pay bills as they fall due for some time and still have liabilities that exceed assets. So I would look at both tests for insolvency, but in this session we're looking only at cash flow. But if your charity does have a risk of being insolvent, our job is to act promptly. And one of the pushbacks I often get on cash flow forecasting is, but we already have a budget. And I get that. But a budget tells us how much income is coming in and how much we expect to spend out. The cash flow forecast predicts when the income will come in and when the expenditure will leave our bank account. And it is entirely possible for a budget to break even or predict a surplus and still run out of cash. And this is a photo of Monsters Inc. They are, this is one of my daughter's favourite films. They had the strapline, "We scare because we care." And so I don't like to do scary finance. Difficult with cash flow forecasting to be positive throughout. And so the budget is a journey. It tells us the journey we're going to take to make social change happen. The cash flow forecast is a destination predictor. Are we actually going to get there? Will the train actually arrive in the station, or is it going to end up on the sidings halfway down the line? And the good news about cash flow forecasting is it doesn't need a deep knowledge of accounting principles. Most of us need to monitor cash in our personal lives. And so, really, we're all cash flow experts. And the best cash flow forecast is done by people that know the charity. You know the timing of the income and the expenditure. You know the uncertainties relating to the timing of the income and the expenditure. And so when we're dealing with uncertainties, as most of us are, the future is unwritten. Joe Strummer, I don't know if there are any Clash fans. We are at best dealing with just different models of the future. And we're trying to find the one that works. But what we have to do first is predict what we think is going to happen, work out what the risk is, and then tweak it. And so let's look at the template. How do we actually do a cash flow forecast? Well, it's done in Excel. There's a standard template and it looks like this. And I'm now going to walk us through it. It's best, folks, to start with the budget. We plot our expected income, expected expenditure, calculate the surplus or deficit, brackets denote negatives, and then we add our opening cash balance from our bank statement, and then we have our closing cash balance. If we don't have a budget, that's okay. We make estimates of our expected income and expenditure, surplus and deficit, and then we add the opening cash balance and the closing cash balance. You don't need to start with a budget. You can build the budget when you're doing the cash flow forecast. But the cash flow forecast, as we know, is all about timing and the bank. And so what the budget does is often have the budget in one column, or as we know, separating out restricted and unrestricted. The cash flow forecast breaks down and presents the same numbers by month because it's the timing that we're focusing on. So we add a column for each month of our budget. And in this example, we have a 3-month budget. Then we schedule the receipts and payments in line with when our real world expectations of when they will hit our bank account. And so sometimes this is easy to do because we know when it's going to happen. For example, rent payments are in line with our contract. We've got the instalments in our lease agreement, and that's easy to predict. But sometimes we're not sure. And increasingly, we're not sure about anything. And so we need to make estimates. And so maybe we've got sums in our budget that we've got no idea when it's coming in. Let's take donations. Maybe this charity raises about 4,000 or 5,000 every year from donations. We don't know when they're going to land. We could talk to the fundraising folks and say, okay, when are the appeals going out? Or do we have any regular payments? Have we got any direct debits set up or standing orders? Or does it all come in at Christmas? Do we do a Christmas appeal or a summer appeal? And if we've got absolutely no idea, then maybe we just phase the timing in equal monthly instalments and track as we go. So we can use the past to predict the future. Sometimes if it's a new activity and we've got no idea even if it's going to work, we have to guess, and that's okay because when we're guessing, we're going to be prudent. So this means being prudent is being cautious. Trustees have a duty to be prudent, and it means scheduling income at the latest point of receipt. So if we're not sure about timing, we push it back. And if we're not sure about the amount, we'll go for the lower amount. And for expenditure, the prudent approach is to schedule the expenditure as early as it could go out of the bank account. And if there's a range, we're not sure how much it's going to be exactly, we might put it at the upper end. So that would be a prudent approach to cash flow forecasting. And so in this example, we think our grant of £1,000 is coming in June or July, but we're not exactly sure. So we're going to check with the funder because we do want that certainty. But for now, we're just going to put it in July, and that will be a prudent approach. And the basis of prudence is that if we can survive the worst case, happy days, all surprises thereafter are positive ones. And so now we need to add the opening cash balances, and we add it to month 1 of the cash flow forecast, and it comes from our real world bank statement. It is a real world figure. And so really, when we're doing cash flow forecasting, we want to start from the beginning of the month. We take the bank balance on day 1 of the month and add that to our cash flow forecast as our opening bank balance. The closing bank balance is an arithmetic prediction based on what we have entered into the spreadsheet. It is the sum of the opening balance plus the income minus the expenditure. And the closing bank balance of month 1 becomes the opening bank balance of month 2. And the closing bank balance of month 2 becomes the opening bank balance of month 3, and so on and so on. And so I think it's really helpful to have some kind of completeness check. And that's why I really like having the column for the budget, because if my total cash flow columns are the same as my budget, and everything in my budget is cash based and expected to come in the period, I've got a higher level of confidence that the cash flow is at least complete. Sometimes we have items in the budget that are not cash items. They might be depreciation. That would be in the budget. It wouldn't come out of the cash flow. So there will be a variance. And that's okay as long as we know what the variances are and they make sense. And it might be timing. We might say, well, actually, in our budget, we've got that £1,000 grant, but actually, although we're entitled to it in this financial year or period, it's not coming into the next financial period. And that's the purpose of the cash flow, to see if the budget works out timing wise. That will give us a completeness check, but it's not going to give us the accuracy check. We can also make sure that the closing cash position on the budget column matches the total cash flow balance on the cash flow. And so what we're doing at all times is marrying up the data in the budget with the cash flow forecast. Now, this doesn't, if it doesn't marry up, if your closing cash position is not the same on your cash flow as it is on your budget, and it's not because of timing issues, it's not because of non-cash items, it might be because there's a spreadsheet issue that you need to go back and check the formulas. And spreadsheets are wonderful, but do have a life of their own. Formulas can get corrupted. They can especially get corrupted if the spreadsheet is passed around a lot and different operating systems apply. And so I would always do the checks and balances. And to be honest, I quite often sit with my calculator and add it up and make sure that the spreadsheet is accurate. And so there is a spreadsheet available on the website, but you need to do your own checks and balances on it and be confident in the formulas. And so that's how the cash flow forecast works. At the moment, we're using a column for every month, right? We're predicting bank balances on a monthly basis. That's normally fine, but there might be times where things are so precarious that we have to actually move to forecasting on a weekly or even a daily basis. And I've absolutely done this. And yeah, find a buddy, find a peer, get peer review, because it can feel quite pressured and can sometimes feel quite stressful. So I would make sure that if you are on weekly or daily cash flow forecasting, do it with someone else, get peer review to catch any. We've all got blind spots. We're all human. We all make mistakes. Peer review is really helpful when things are really tight. And actually, problem shared is problem halved, yada, yada. And so think about what you're using the columns for. Now we've got online banking, most of us. Actually, weekly and daily is possible. In the old days, that was really very difficult because you could only get one monthly paper bank statement through the post. I'm probably showing my age. Now we need to look at how far ahead we're looking. So our example has been for 3 months, simply to fit it on the page so that the font is big enough to make it clear to illustrate principles. But we normally need to have a minimum of 12 months to be confident we are a going concern. And so most cash flow forecasts have 12 months. When 1 month drops off, we add another month onto the end and we keep that 12-month visibility. But it might be that you have a strategic plan that's 3 years or 2 years and you want to model future cash balances to test the viability. And in that case, other considerations apply about discounting value for time. And we do not go into that now. But if you are doing a long-term cash flow forecast, you might want to talk to an accountant, is the point I'm trying to make. We've got the cash flow forecast. We are cash flow experts. We now need to maintain it. And we need to keep it up to date because it's a guesstimate. It will not come to pass. The budget's out of date the minute the ink is dry. Cash flow forecast will be out of date the minute the ink is dry. It is very likely the future won't come to pass exactly as we expect it to. And if that happens to you regularly, where the future does come to pass exactly as you expect it to, I'd buy lottery tickets. But every month we need to check the numbers. Is our closing balance on our forecast the same as the one in our bank account? If not, we need to correct it. Maybe income came in earlier than anticipated and we've got to bring it forward in the cash flow forecast. Maybe expenditure hasn't gone out, it's going to go out later, we need to push it back. Our closing cash flow bank balance for the past month should match our actual bank balances on our bank statements in the real world so that our future opening bank balance is correct. Now you decide whether you go back and change all the numbers. Sometimes I do, sometimes I don't. I'm certainly checking to see what was in the month and what wasn't in the month and why the variance is there and what I need to move around for future months. I don't anymore, I'm going to be honest, diligently update the past. I've normally got another system for that, but some people like to. That's your call. What we are doing, without a doubt, red line, updating the future every month. So we need to maintain 12 months visibility. We want that really long-sighted clock. Every time we complete a month, we update the forecast to bring it in line with what happened in the real world. Then we add a month to maintain that 12 months visibility. And how are we going to present it? Well, folks, this is a really integral bit of financial storytelling. We are all experts in our sector at telling social stories. And I think as charity leaders, we also need to be experts at telling our financial stories. And effective stories have words, pictures, and numbers. And a cash flow forecast, we suggest, really benefits from having these three also. So an example narrative might be really, really dead simple, but you're getting the key messages across. Look, My Shed is Blue is a charity, supports people that are leaving prison by building carpentry skills and building sheds. And it's set a budget, and maybe it aims to turn a surplus of 6,500-ish in the 12 months from January. And when we forecast the future cash balances, we can see we'll have significant challenges with negative balances peaking at 2,000 in April. And this is largely due to a grant not being due until June, and we need to take corrective action to remain solvent. So this is a fictitious example narrative that states what's going on, what we think is going to happen, what the problem is, and what we need to do about it. And there are 3 golden questions in finance. What are the numbers? So what does that mean? Now what do we do? And if you can do the what, so what, now what in your narrative, that tends to be quite a strong message. Then we have the numbers. So this organisation, My Shed is Blue, has got this 18,400 in, 11,800 out, with that surplus we've already mentioned of about 6,500. There's a big grant of 10,000 coming in June. And as the narrative said, we have significant cash flow issues because although we are turning a surplus, the timing of the grant means that a lot of the expenditure is going to go out before the money comes in. If we haven't got a loan, if we haven't got an overdraft, very likely the bank would just turn the tap off. And you can actually close in this period, be forced to close, even though the money is coming in. And so corrective action does need to be taken. This is a super useful report because it's told me I cannot survive the possible version of the future that I think is most likely. I either need to push expenditure back or I need to bring the grant forward. Simples. And then maybe some people respond not to words and not to numbers, but to pictures. And this is pretty clear. If this is a zero bank balance here, and these are the months going across the bottom, all of my bank balances are negative until I hit June. And so if I'm presenting financial information, maybe I've got a monthly finance pack with a cash flow forecast in it, I really want words, pictures and numbers that tell me the what, the so what, and the now what. And then what questions do we ask? Okay, we'll be the curious leader. Our job is to understand what's actually happening in the real world and imagine what the impact would be when we're doing cash flow forecasting if income arrives late or expenditure is earlier than we thought. What are the numbers? Are they positive? How low do they get? How soon do they get that low? Do we need a forecast for restricted funds? Our example here is a melting pot. We've got restricted and restricted in there. Maybe we need to do them separately. So what does that mean? Are we solvent? Can we pay bills as they fall due for the next 12 months? If not, what are we going to do about it? We're probably going to have to correct that. We probably don't want to hit the iceberg or have to get the lifeboats out. And so what do we do? Can we pull income forward? Can we increase it? Do an emergency appeal? Can we push expenditure back? Can we decrease it? Move to flexible costing in some way? Do we get an overdraft? Can we get a loan? Does our constitution permit that? When we're managing short-term difficulties, a cash flow is really super useful. And it's also really super helpful to be familiar with Charity Commission guidance, CC12, Managing Financial Difficulties. Read this while the sun is shining. You will be forearmed if you ever need it when the rainstorms come in. When difficulty is on the horizon, our job is to act decisively and swiftly. In managing charity finance, Charity Commission says we have 6 duties. You protect the money, manage payments to trustees, keep good financial records, know the financial position, and manage difficulties promptly. We also keep the register up to date. So we might need to get proper professional advice, and we always need to take a people-centered approach because this is in stressful territory, and look out for each other. When we're managing long-term resilience, if cash flow is an evergreen challenge, maybe we need to make structural changes to the way we operate. Maybe the business model needs to change if it's no longer working. Is there a different way? If we started our charity today with our assets, our people, our learning, our mistakes, would we build it in the same way? How can we structure our activities to maybe front load income or build a more flexible cost base so that we can murmurate like starlings, expand when we're able, contract when we can't? In our sector, it's really difficult to contract. It feels like a failure. People need us. People rely on our services. We feel like we're letting people down. But sometimes contraction is not, I don't think contraction is ever failure. I think often it is an excellent, brilliant, insightful strategy for survival. Can we murmurate like starlings? Can we regenerate and take on more kind of nature-based ways of operating? Nature doesn't just keep growing, although my garden does. It ebbs and flows. Maybe we need to ebb and flow as well. And maybe we need a plan. And so what are the common mistakes when it comes to cash flow forecasting? Well, we're an ostrich. We put our head in the sand. We assume it will all work out. Or we're really optimistic and we are Icarus. We fly too close to the sun. We think there's going to be a load of income coming in that has not yet been secured. We include it as if it has. And we are massively over optimistic in the timing, not only the amount, but the timing of the assumptions. If you are a naturally rosy person who gets up and feels great about the world, try and find someone a bit more like me who's a bit more Eeyore and pessimistic, who's going to sit there and be the annoying person and say, I don't know, what about that? What about this? What if? And if you can do that, then you can see the problems You still need to act. It's not enough just to see them. Often I see us with the visibility, but we're still not doing anything about it. You've got to grasp the nettle. Do not be a boiling frog. And the role of finance, this is, I mean, a good finance system will tell us when we've got a problem, but a really good one, which involves us acting, is going to buy us time to fix it. And our job is to keep looking around the corner. And so, what might you do? Well, the invitation today from this is prepare a cash flow forecast, incorporate it into your monthly finance pack, monitor your closing balances, keep everyone involved that needs to be involved, run it up the flagpole where you need to. And in the event of a serious problem, read CC12 and get professional advice early. Don't, you can misstep when the rain clouds come in. Don't be, yeah, forewarned is forearmed. And then just think about what the cons are. When cash flow problems come, things change really quickly and it can get quite stressful. Our job is to remain in that rational, calm thinking space wherever we can and communicate clearly. And if you really need further information, there's some fantastic resources here, folks. There's so much to support out there. And if you want to join our mailing list, please do. And there are resources on the website. Yada, yada. You know all of this. Really, really nice.